very happy to bring you to a street corner that I have visited many, many times in my career. We're at 19th and Pennsylvania Avenue, a place of tremendous significance in world history and in the world financial system, because where I'm standing is right at the corner where I have the World Bank over my right-hand shoulder and the International Monetary Fund over my left-hand shoulder. These are the two so-called Bretton Woods institutions that are global institutions, each with around 190 member states that are central in the role of the world economy. The IMF and the World Bank were created at a conference in 1944 in Bretton Woods, New Hampshire. This is a hotel where delegates from the countries of the world at that time, still at war, assembled to work out a new financial system for the post-World War II world. The great intellectual at the conference was the British economist John Maynard Keynes, whom we refer to in economics nonstop as the father of Keynesian economics, the economics of Keynes, about stabilizing a national economy or the world economy through monetary and fiscal means. John Maynard Keynes was the greatest political economist of his age, a British economist who was a brilliant thinker and from early on a brilliant participant in public policy from the time of World War I through the end of World War II, when he passed away soon after the end of World War II. In World War I, he served as an advisor to the British Treasury, notably at the end of the war in the negotiations over the Treaty of Versailles that ended World War I. And the Treaty of Versailles imposed very harsh conditions on Germany and the other states on the losing side of World War I. Notably, heavy reparations burdens were imposed on Germany for years and years to come. And the measures that were taken were punitive, harsh, and led to great economic difficulties during the 1920s and then especially during the 1930s. In the aftermath of the Treaty of Versailles, in 1919, as a young economist, John Maynard Keynes wrote a book that is one of the most important books of economics of the 20th century, The Economic Consequences of the Peace. By the peace, he means the peace agreement, the Versailles Treaty. And by economic consequences of the peace, Keynes is referring to his view in 1919 that the harsh conditions imposed on Germany would come back to haunt the world, that the reparations burdens and other burdens that arose from World War I, for instance, the debts that countries owed to each other for wartime expenditures, would be so burdensome on society, new militarism would arise in the next generation. Of course, Keynes was prophetic in this view because Germany suffered major economic dislocations in the 1920s and 1930s. In 1923, succumbing to a hyperinflation, and then in the late 1920s and 1930s to the Great Depression. And that economic turmoil and the fact of the loss of World War I and its political backlash provided the grounds for Hitler's rise to power in January 1933. Keynes was proved right that the harsh economic conditions would give rise to great political instability that would come to haunt Europe once again. Keynes also observed the dislocations that followed World War I in the monetary systems, in the failure of the return of the European countries to the gold standard, which had been suspended during World War I, but which was resumed in the 1920s. The gold standard meant that each country committed to backing its national currency with its reserves of gold. And that, of course, limited the ability of the central banks of those countries to respond to economic crises, because the banks understood that they should not issue new credits or expand the money supply unless it was backed by gold. So the gold standard was also a kind of straitjacket on the major economies of the 1920s. And when the world fell into Great Depression in 1929, the gold standard continued to be a straitjacket on remedial measures to help escape from the Great Depression. During the period of the 1920s and 1930s, John Maynard Keynes was saying we need to end the reparations burdens, but also to move beyond the gold standard. The gold standard is constricting the world economy. The gold standard is destabilizing our societies. We need to invent a new financial order, not dependent on the physical supply of gold. Well, that brings us to 19th Street and Pennsylvania Avenue, because it was during World War II that the United States and Britain began to plan for a post-World War II monetary order. And that culminated in the Bretton Woods Conference in July 1944. At that conference, John Maynard Keynes wanted to make a clean break with gold and to give a new institution, the one over my left-hand shoulder, the International Monetary Fund, the power to create liquidity so that depressions could be counteracted by expansions of credit by this new global institution. Keynes said, let's move beyond the gold standard to a human-made standard that could respond to crises such as the Great Depression. Well, in that conference, Britain was, of course, one of the United Nations of the time, together with the US, the Soviet Union, and China. And Britain had been the world's most important financial center for more than a century up to World War I. But Britain didn't carry the political weight in 1944 that it would have carried in 1914 or 1910 before World War I. World War I, the Great Depression, and World War II had tremendously weakened Britain, had put the British government into deep debt, and it meant that even though John Maynard Keynes was no doubt the greatest monetary thinker of the age and the greatest genius at the Bretton Woods Conference, he did not quite carry the day, because on the other side stood the United States government. And Harry Dexter White, a senior Treasury official representing the U.S., said, no, we will not turn the world monetary system over to the International Monetary Fund. We, the United States, plan to be the next power at the center of the world monetary system. Britain, yes, you're a bit of a has-been. We will be the new power. And an arrangement was reached which went in some modest way towards Keynes's vision of an international organization that would provide liquidity in the case of international crises, but which also put the United States and the US dollar at the very center of the world monetary system since 1945. And arguably, the United States dollar remains at the center of the world monetary system till today. The arrangement that was reached included some aspects of gold, some aspects of Keynes, and some aspects of a dollar-based system. The idea that was arrived at, called the Bretton Woods monetary system, was that the United States dollar and the US dollar alone would be backed by gold, meaning that if other central banks wanted to take their dollar reserves to the US government would give gold at a fixed price at $35 an ounce in return for those dollar reserves. So the US would remain on the gold standard, but all the rest of the world, in effect, would enter a dollar standard where instead of holding gold reserves, these other central banks would hold US dollar reserves. And therefore, the US and US monetary policy became the center of the international monetary system. Now, at the same conference in July 1944, a parallel institution was created, the next door neighbor, the World Bank, at the time officially called the International Bank for Reconstruction and Development. And it was foreseen to be the bank that would provide the financing for the investments to rebuild the war-torn economies. It was also seen in a new light, which was also a kind of new vision of the world, and that is as a financial institution to help poorer countries get the bank loans that those countries need to make critical investments in roads or in water and sewerage or in the power supply so that they would have the means to begin a path of economic development. So the World Bank was created to help the rebuilding effort after World War II and the poor countries. The International Monetary Fund was created to provide some measure of liquidity in a new dollar-based monetary system. When Keynes was asked to explain the difference of the fund and the bank, he said it's quite simple. The fund is a bank, and the bank is a fund. And what he meant by that is that the fund, the International Monetary Fund, would lend money at short term to help governments that were facing a liquidity crisis, that needed cash quickly, whereas the World Bank would actually give money on exceptionally good terms, including even grants or long-term loans at below market interest rates to fund reconstruction and development. Well, this corner for me always represented economic power and the center of the international financial system. And its very location obviously reminds everybody, and always reminded me every time I walked along this corner, of where the real power lies in this system. Because here we are at 19th and Pennsylvania Avenue, the International Monetary Fund. At 18th and Pennsylvania Avenue, the World Bank. At 17th and Pennsylvania Avenue, the Executive Office of the President of the United States. At 16th and Pennsylvania Avenue, the White House. And at 15th and Pennsylvania Avenue, the U.S. Treasury, which really has called the shots for generations. So the role of the IMF and the World Bank has been challenged and contested from the start, even as Keynes was being put in his place by the now more powerful the United States. British ambassador supposedly said in Washington, Lord Halifax remarked to Lord Keynes, "They have all the money bags, but we have all the brains," referring to Keynes. But the money bags triumphed, and the money bags would continue to triumph for the coming generations. The U.S., in effect, ran these institutions to a very large extent, although they are truly multilateral institutions with around 190 member states, all with voting shares and all with a role. But there is one first among equals, and that has remained the United States to this day. The IMF has never quite played the role that Keynes envisaged as a true international lender of last resort. Rather than providing credit and liquidity as needed when countries get into crisis, the IMF became a crisis manager, not a liquidity provider. By the time countries come to the IMF for an emergency loan, they're in a lot of trouble. It's the intensive care unit. The World Bank has played its role in international development. It actually was not the central institution for post-war reconstruction. That title went to the Marshall Plan, which was a direct U.S. government plan to support the rebuilding of Europe after World War II. The bank became the central institution for international development financing, and it remains an absolutely critical institution until today. But it is also fair to say that the world economy grew massively, and the bank was not allowed to grow alongside the scale of needs of the world economy because the United States kept a heavy hand on the bank. And until today, we are in contested territory. Finance is also politics, remember. And part of the politics today is the relative power of the United States versus China and other countries. And that competition over voting power and power to make policy continues to keep these two institutions very much in the middle of the contest. They do not expand as they should, in my view, in part because the United States does not want to hand more power over to China and to other rising economies, because the U.S. wants to keep its hold on these institutions. The implication, however, is the institutions cannot fully live up to their need and to their promise that was set at the Bretton Woods Conference in 1944.